What if I told you there's a way to invest in companies with the potential to double, triple, or even 10x your money? That's the promise of growth investing strategy. Welcome to your Investing Partner channel, and in today's video, we're diving into the exciting world of growth investing. We'll explore what it is, its key principles, how to identify promising growth stocks, and the pitfalls you should avoid. Stick around to the end for actionable tips you can start using today. Let's jump right in by understanding what growth investing is all about. Growth investing is about buying stocks in companies that are expected to grow at an above-average rate compared to the market. The core idea is that these companies often reinvest profits to expand rather than pay dividends, aiming for exponential revenue and earnings growth. Think of companies like Tesla or Amazon in their early days. They focused on innovation and market dominance, rewarding patient investors with massive returns. Does that sound exciting? Well, to fully grasp this strategy, let's dive into the principles that drive it. The first principle is focusing on high revenue growth. Growth investor looks for companies with consistent double-digit revenue growth. This signals strong market demand for their products or services. If you notice revenue growth consistently exceeding 20% annually, it's a strong indicator. Such growth often indicates a thriving business that's scaling efficiently. It's also a signal of market traction and customer demand. The second principle is to invest in innovation. Growth companies often lead in emerging industries like tech, healthcare, or clean energy. Consider Tesla's leadership in electric vehicles as an example. These are companies that not only innovate but also redefine industries. They are the pioneers. And as an investor, you're betting on their vision becoming reality. To assess innovation, look at R&D spending and whether the company consistently brings disruptive products to market. The third principle is long-term vision. Growth investing requires patience. These companies might reinvest heavily, causing short-term volatility, but the long-term payoff can be substantial. We can take Amazon during its early days as an example here. It took years of reinvesting profits into growth before becoming the giant it is today. This is where your belief in the company's potential is crucial. Success comes to those who wait. Always evaluate whether management has a clear plan for scaling sustainably. Now that we understand the principles of growth investing strategy, the big question is, how do you spot these growth gems? Let's break it down. Step 1. Check financial metrics and look for high earnings growth rates, 20% plus, increasing sales, and a strong return on equity, ROE. These metrics provide a snapshot of the company's financial health and its ability to generate profits. Consider a company like Nvidia, which has historically shown strong revenue growth and high ROE during its peak innovation phases. Such metrics can signal a promising growth trajectory. Step 2. Evaluate market trends by asking the following question. Is the company operating in a growing industry? Riding the wave of a booming sector often amplifies a company's growth potential. For example, companies like OpenAI have risen with the growing demand for artificial intelligence solutions. By analyzing trends, you align your investments with the future, not the past. Step 3. Research the competitive edge. Look for a company with a solid moat like patents, brand loyalty, or proprietary technology. You should detect the company's competitive advantage that protects its market position. For instance, Apple's ecosystem locks in customers, making it hard for competitors to break in. To spot a moat, analyze what sets the company apart. Does it have unique assets or a strong customer base? Companies with strong moats are better equipped to sustain growth and fend off competitors, making them prime candidates for growth investing. I want to thank you because you've made it this far. If you're getting value from this video, drop a rocket emoji in the comments. This lets me know you're following along and enjoying the content. I'll be happy to see and reply to your comments and questions. Of course, not every growth stock is a winner. Let's talk about the mistakes you'll want to avoid. The first one is overpaying. Even great companies can be bad investments if the price is too high. Check valuation metrics like the price-to-sales (PS) ratio. For instance, if the PS ratio of a company is significantly higher than its industry peers, it might be overvalued. Imagine buying an amazing car but paying twice its value. Not smart. Avoid falling for hype and always evaluate whether the stock's current price aligns with its growth potential. The second mistake is ignoring profitability. Some growth companies burn cash without clear paths to profit. Be cautious with these. Examine metrics like negative free cash flow, or high cash burn rates compared to revenue growth. For instance, a company spending more than it earns just to sustain operations may struggle long-term. Beyond these metrics, check for declining operating margins or recurring losses in quarterly reports. Growth is great, but eventually, the company needs to make money to reward investors. And the third and final mistake is selling too early. Don't let short-term market dips scare you into selling. Growth investing rewards patience. Take Amazon during the dot-com bubble. Many sold early, missing out on decades of gains. When you've done your research and believe in the company's long-term vision, stay committed. Think of a roller coaster. It dips, but the thrill is in the climb. Consider setting clear targets or using a staggered selling approach to manage risks while staying invested. To conclude, growth investing is your ticket to finding companies with the potential to deliver extraordinary returns. By focusing on high-growth industries, innovation, and solid fundamentals, you can align yourself with the leaders of tomorrow. But remember, patience and research are your best allies in this strategy. That's all for today's breakdown of growth investing. If you're new here and haven't watched our value investing video yet, be sure to check it out. I'll link it in the description below. It's the perfect companion to today's lesson. Before you go, I'd love to know, which growing company do you think has the most potential right now and why? Share your thoughts in the comments below. In the next video, we'll explore dividend investing and how it can create passive income streams. Stay tuned and see you in the next video.